Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is a special edition where we're going to be talking more about how the importance of today's RBI's monetary policy decisions really mean for your own lives and for the economy at large. Joining in with me on this show is a very special guest. Aditi Nair joins in, economist from ICRA. Welcome, ma'am, and thank you so much for taking the time out for this discussion. Well, first up, I want to kickstart by asking you your own key takeaways from the RBI governor's decisions. Status quo policy, which was largely on the expected lines, but has it really met your own expectations as well?
Today's policy was pretty much along the lines that we were expecting, with another pause and an unchanged stance coming in from the MPC. The growth forecast was not changed for the year as a whole, but there were some tweaks in the quarterly forecast, and the CPI inflation forecast, as we expected, Q1 was brought down and the year as a whole was brought down only very mildly. So overall, on all these lines, there really was not much surprise, and in line with what we had seen in the previous policy, there was a great emphasis that we need inflation to come back to 4%, not just come below 6%. And I think that is something that, the markets must take away, and economists like myself must take away very, very clearly, that the bar has been lowered to 4%. It's not 6% anymore. And I think that is why we believe, which we did even before today's policy, this re-emphasis today, that rate cuts are pretty far away. Inflation will have to fall very decisively towards 4% for rate cuts to start. There's a very unlikely case for a rate hike at this point in time.
Okay.
So most likely we're in for a pretty long extended pause, I would say.
Long extended pause. So anyone expecting a rate cut to start at the end of this year, maybe October, December, will be disappointed, you say?
Yes, I think so.
So when exactly is the rate cut going to start? If next year, then when?
See, as of now, the MPC's own forecasts for quarterly inflation remain above 5% for the next 3 quarters, so Q2, Q3, and Q4. And only after that can we start expecting at best, we'll be looking at lower than 5% prints sometime in the next fiscal year. So my sense is that most of this fiscal year, we're unlikely to get a rate cut.
Okay, but like you pointed out on the hikes as well, the stance still is maintained at withdrawal of accommodation, which largely is a jargon for, like, we are not away from the rate hikes completely. Your own sense, how would you really look at the situation? What are the factors that could perhaps still overweigh the RBI's decision to perhaps go for one more rate hike? Or do you think the rate hike differential with the Fed may continue going forward as well?
So what can lead to a rate hike? Possibly two things. One, inflation significantly overshooting the quarterly projections that the MPC has put out for Q2, Q3, and Q4, which could happen if we have a very bad monsoon outcome, and that's nobody's base case. At the present juncture, what we are expecting is that there could be an El Nino in the second half of the monsoon season, which is what is basically leading to some amount of uncertainty as far as the inflation trajectory for the second half of the year is concerned. That, however, may not be enough by itself to actually lead to any rate hike. So that's not the base case. The second thing, if growth falls substantially below what the MPC has projected, our own forecast for growth is 6% for this fiscal year, and we have an upside of 50 basis points if the capex cycle kicks off early, because there's a lot of money on the table from the center and the state governments to support capex. How quickly that kicks off, and if that can create a quick virtuous cycle, that could lead to GDP growth being higher than our 6% baseline, and a very bad monsoon outcome could lead to growth being closer to 5.5%. So at 6%, we don't think that there is a case for rate cuts coming in very soon, given the inflation projections that the MPC has put out, and the clear emphasis, which I'm repeating, on inflation coming in to 4% and not just being below 6%.
Okay. Is there still space for lending and loan rates to go up in between this time, of a rate hike or a rate cut, because you're looking at an extended pause right now? How would you look at these rates?
I think a little bit of transmission may still be left to play out, but it may not be very substantial, because possibly now we've already been 1 year into the rate hike cycle, so some transmission has already happened.
Okay, and any what about the deposit rates? Are they near their peak or at peak?
I think similar. I mean, it would be a similar answer to that as well.
Okay, what would you really have to say on the liquidity? The RBI governor has made statements on the 2000 rupee notes coming back into the system, 85% of which are in the form of deposits. 50% of the notes have come back into the banks as well right now. 1,80,000 notes have actually come out as of now as the statements have come in. What would that mean for liquidity situation in the system, and would that warrant at any point in time for the RBI to have a relook at the way they form policies?
So this is definitely something that is going to boost the liquidity surplus at least temporarily,
Hmm.
and therefore the requirement for OMOs etc. may go down a little bit. So I think it's a bit of a wait and watch on liquidity. Earlier we thought that durable liquidity will tighten towards the second half of the year, and that may eventually set the stage for the last year's CRR hike to be reversed. But
Hmm.
I think the case for that is weakening after the move on the 2000 rupee notes.
Okay. What about the bond market yields? They were already higher before the policy. How do you see those moving up?
So, here again, now with this clarity again that 4% is what we're looking at,
Hmm.
I don't think the 10-year bond yield is going to remain below 7% for an extended period of time. It's been very range bound since the last policy, sort
Hmm.
of being up and down around the 7% mark. So I think our view is that 7 to 7.1 or 7.2 is likely to be the range going forward. Particularly in the month of April, there wasn't a lot of state government borrowing happening, and that is something that may pick up in the coming weeks and months. And that would be another reason for the 10-year yield to be slightly higher than 7%. That's our baseline.
All right. Thank you so much, Aditi, for being with us on the show and decoding the RBI policy decisions for all our viewers. Always a pleasure having you with us on Business Today TV. So Aditi Nair right there, Chief Economist at ICRA, talking about, what her own takeaways were from the RBI's Monetary Policy Committee meeting and the kind of decisions that have come about. But what do the decisions really mean for financial markets and for you as an investor if you're an equity investor at large as well? Joining in to discuss all of those details as well with us is Mr. Abhishek Basumalik, founder of IntelSense Capital. Welcome, sir, and thank you so much for taking the time out for this discussion as well. Well, we was looking at the markets really cheering away for a large part of the speech that was given at 10 a.m. and beyond that as well. In fact, the markets were inching up, but then suddenly they've slipped into the red. What's caused this kind of slide in the markets? Was there anything in the fine print that the markets have decoded in the policy?
I don't think so. I mean, I think this is probably normal profit taking. Markets have been on an upswing for the last few days, especially the small caps, which were practically on a tearaway run last, I think, 3, 4 days. So I think this is normal profit taking, which I personally think is very healthy. I mean, I would be very concerned if small caps continue to rise every day
Okay.
and then sort of creates froth. So I think this is good. I mean, some bouts of profit taking on and off is good.
Okay. But nothing negative for the markets from the policy, you say?
This policy was completely, a non-entity in my opinion. There's nothing expected, and nothing happened. So it was just something that was a checkbox that had to happen, has happened, and I don't think people tomorrow morning will remember what was happening here.
No, but I wanted to understand from you, do you think a slight bump up in the GDP forecast that remains absolutely status quo from the last time around, or a sharper decline in the inflation forecast, barring this just 10 basis points of a cut that we saw, would have made markets happier?
See, I'm not an economist like your previous guest, but my sense is that if you look at GDP, RBI's guidance in general has been a little bit away from what the country has actually delivered. So once the revisions come in, the numbers change substantially. So there's nothing much to take away from RBI's forecast. So that's point one. In terms of inflation, I think in India, if you break down inflation numbers, you will see that inflation primarily comes from two sources. One is fuel inflation, second is food inflation. Now, fuel inflation, again, both of these are not in the control of the RBI's monetary policy, right? So, I mean, no matter what we say, no matter what the governor says, ultimately, most of this part is not within the control of the RBI. What they do is, they tinker with the rates here and there, and it gives an impression that they're on top of things and they're driving something, but essentially not much changes, or the changes are pretty long lasting, and most of it is market driven anyway. I mean, if fuel prices go up, people adjust to it. If food prices go up, people adjust to it, and vice versa.
Okay. Post the policy, is there any change in stance that you would have on the rate sensitive sectors? Would you be more bullish on any of those as well? We saw FMCG stocks hitting new highs yesterday as well. Do you think the consumption basket, the real estate space, any of this gets more attractive from here on?
See, I mean, forget the RBI policy. I mean, look at what is happening in and around us. If you see that, you will see what is happening is that in consumption, we are seeing a K-shaped kind of recovery in the country. Rural is still uh, in in recovery, in some amount of distress. So until and unless that part gets better, we will not see a very large improvement in corporate results, especially which cater to the masses. Uh, so until and unless that happens, the primary driver for growth will remain the capex driven sectors, where the government, both the central and the state governments, are spending a lot of money, right? So if you look at sectors which are doing well for the last year, it's been engineering, it's been railways, it's been defense. So these are pockets where the government is spending a lot of money, and that is what is currently driving the corporate results.
Okay. Uh, uh, you know, um, like you just pointed out that you'd be a little apprehensive if the small caps continue to rise like that. But where should investors really draw comfort from in this kind of uptick that we've been witnessing in the markets? If you stay with the winning sector, which is that sector that should still provide you some comfort?
See, I think first of all, for investors, it's prudent not to chase prices, right? I mean, we've seen individual stocks which have gone up 40-50%. In some sectors, like the wind sector, some stocks have just risen through the roof
Yes.
in the last 1 month. It's
Yes.
better not to chase those fads, or I mean, I don't know whether it's a fad or not, but it's better not to chase them
Yeah.
after very steep rises. It's better for you to take a step back and let things cool off. There are a lot of opportunities if you take a structural bet. There are opportunities uh, in chemicals that is starting to look interesting in some pockets. You start looking at pharma, which is sort of not performed at all for the last year and a half, maybe more than that. So those are areas where you need to start working on in terms of identifying companies which are likely to come out with improved results. So those are the pockets where I think it's more prudent now to look at, rather than chase the fancy of the month or the fancy of the week.
Mm-hmm. The governor also talked about the fact that how FPI flows have turned favorable and has been led by the equity as well. Do you think that the phenomena is likely to continue going forward?
Absolutely, and I think the foreign inflows into Indian markets, both debt and equity, is going to be a long-term structural story, right? I mean, if you look at what is happening in geopolitics in across the world, in terms of economies across the world, India does stand out to be one of the bright spots. Uh, it is also a very large market, large domestic market. It's a large equity market, and it's also a very diverse equity market. It's not like some other countries, other large emerging market countries, where the options for foreign investors are very limited to maybe 10, 12, 15 stocks. Yeah, the large companies here, at least the options of buying very diverse sorts of companies is there. We have very large presence of MNCs in India. So the opportunity size in India is significant, which I personally think foreign investors as well as domestic investors are likely to continue to invest for at least the next, I mean, more than 5 years, in my opinion.
Okay, okay. But at this point in time, to your mind, which is the most overrated sector and the underrated sector in the current markets?
Difficult to say overrated, but I would be very cautious about sectors or stocks which have run up very fast. Things like especially defense and those kinds of plays. You'll have to let them cool off a bit. Uh, and in terms of under ownership, in terms of under research and those kinds of things, I would still say pharma, chemicals uh, are good places to start looking at. For even maybe IT, right, are good places to look at for now. And you may not be investing today, but at least you can start your research, look at good stocks within those spaces, and then maybe buy in a SIP kind of mode.
Okay, understood that. Well, thank you so much, Abhishek, for being with us on the show and discussing with us what the policy decisions mean for the average investor right out there, and should it or should it not really influence our investment decisions going forward from here. Many thanks. Good to have you always on Business Today TV. The market's sulking a bit, 90 points of a decline on the Sensex, 63,053. The Nifty is slipped below that 18,700 mark as well, about a 32 points of a decline right there. Perhaps those profits being taken right at the top for the markets currently. In fact, if you talk about the broader markets, they're seeing a sharper decline. 0.5% of a cut for the small caps. The mid caps also seeing a 4.4% of a cut as we speak as of now. Let's also look at the gainers and the losers as we close down this show. As far as the Nifty gainers are concerned, you do have a whole host of names coming in as far as JSW Steel, Power Grid, NTPC. So power, steel names really looking at some gains coming in, 2.5%, 3% odd. We've seen ONGC also on top of the gainers list. L&T, ICICI Bank, the other gainers at this point in time. Also HDFC Twins and Cipla, they're also seeing eking out about 0.5% of gains at this point. Now, when we look at the losers, you do have again a wide variety of stocks from various sectors, like Grasim is down in trade, 2.5% down. Sun Pharma is seeing some profits being taken off. BPCL sulking 1.2%, 1.7% in fact down in trade. Apollo Hospitals, M&M seeing some profits being taken off, and Kotak Mahindra Bank also declining in trade. But we'll keep an eye on how the markets shape up from the this point to the last point of the day, and whether there is any kind of a recovery coming in from these dips that you're seeing in the markets. But for now, it looks like the markets are actually sliding even further. But we'll keep an eye, and you should stay with us on Business Today TV. Don't forget to subscribe to this channel and continue to engage with us on our other social media platforms as well. Until then, many thanks for tuning in.